Yeah, thanks for having me, guys. So my name is Brian Belley. I'm the founder of Crowdwise at crowdwise.org, and I help investors learn how to invest in startups specifically through equity crowdfunding. Now, along the way, I also started helping issuers, which are the companies who are raising capital from the crowd. And again, the focus is really on the online investment platforms through regulation crowdfunding or Reg CF. And I basically started it because as an investor myself in the space, I've invested in over 130 companies now. I saw a large gap in terms of the educational materials that were out there to be able to help people learn how to invest. So kudos to you guys, Evan and Jeff, for helping with education like this to be able to help people online looking for this information. But yeah, I basically started investing myself, and along the way learned a whole bunch from angel investing blogs, venture capital blogs, books, podcasts, everything in between. And then I take those core pieces that really help startup investors and apply it to equity crowdfunding.
What should investors know? I mean, you're a good example of one, but what should they know before jumping into an equity crowdfunding campaign?
Yeah, that's a great question. I mean, the first thing you have to know before anyone considers investing is that it's highly, highly risky, right? This is money that you're going to be investing in companies should be money that you can live without, because if you get a return ever, which is a big question mark, because these are really, really nascent early stage companies, and a lot of them are unfortunately going to fail. But if you ever get a return, that return isn't something that's called a liquid investment. So you can't necessarily just say, oh, I need the money back, so I can't go and sell this stock like you could on a public market. Basically, what happens is you need to wait for an exit or a liquidity event. So maybe it's an IPO, but that could take 10 years or more. Maybe it's an acquisition or a merger with another company, but on average, if you look at the angel investing data that's out there for early stage companies, it's 5 to 7+ years on average to kind of get your money back. And that's assuming you get it. So the question then is, okay, Brian, if this is so extremely risky and I'm probably never going to get my money back, or it's going to be 10 years before I do, why would I invest in this? Well, the reason that a lot of people invest in this is kind of twofold. So, right, most people are probably looking for some amount of financial return, or the ROI on that investment. And what investing in startups and early stage companies does is it provides diversification in a portfolio. So if you take a really small amount of your investments, again, something that you're okay losing, you're okay doing without because of the risk, but there is a very, very small chance that that very small allocation towards startups could turn into an overall pretty significant portion of your portfolio. So again, in the venture capital industry, you'll hear of them looking for unicorns, right? Which is a company that's worth 1 billion or more in valuation. And for a smaller investor, if you're investing like on some of these equity crowdfunding platforms, you might not even need a unicorn to have a really good outcome. So let's just, for an example, right, a lot of early stage companies might come at a 5 million or a 10 million valuation cap. So if you had a 5 million valuation, company that you invested in, and let's say that they don't even become a unicorn, let's just say they have an exit for 500 million, which is still an amazing exit, right? But you've gone from 5 to 500. That's about, a 100x return. Granted, there's probably some dilution because when you do follow on equity financing rounds or financing rounds in general, you're going to be a little bit more diluted. But the idea is that you get a smaller piece of a bigger overall pie as that company grows in valuation. So even with 50% valuation, that's a 250x return on your initial investment. So the key, right, and to go back to the crux of your question, what should investors know? It's highly risky. It's a liquid. You got to be aware of all that. There is a chance for a big return, but because of the way that the high probability of failure for early stage startups, you want to create a really diverse portfolio. You want to make sure you're spreading your bets among a bunch of companies and really small investments, because the probability of any single one of those investments going to zero is probably pretty high, unfortunately. But if you hit that one outlier in a larger portfolio of diversified, startups, then if you get a 250x return, for example, that could kind of return, all of your investment portfolio overall. So there's lots of data out there, and I'm a big data analytics geek myself. Published from AngelList and King's Crowd for the equity crowdfunding markets is another great resource. Full disclosure, there, I'm an investor in King's Crowd, but they put together just a lot of really transparent data on the industry and show trends and different things in terms of companies that have raised. So I guess that's what I would say overall. Just know that it's very risky, that people are doing this, for a financial return when they do that, that they're diversifying. But that brings me to kind of the second reason they invest, right? So I mentioned the one reason they invest is, looking for a financial return. Second reason that a lot of people investing is honestly because they believe in a founder or an idea or a company, or there's something that they see in the world that they want to exist. So you'll hear a lot of angel investors say that if they don't invest for, pure financial returns, they're investing because they want to give back, right? They want to kind of pay it forward. They've been a founder, doing this day-to-day grind every day and really trying to, make something great. And so they really appreciate when someone takes a chance on them to allow them to happen, to allow it to happen. So yeah, in summary, that's what I'd say.
Thanks, Brian. So how do you find your deals and do due diligence on these opportunities? And kind of curious, of the 130 plus that you've invested in, how many did you look at, and what does your funnel look like when you're actually doing due diligence on deals?
Yeah, that's another great question. So you find them, and you have to find them if we're talking about regulation crowdfunding, Reg CF, because that was created from the Jobs Act, which is the Jumpstart of Business Startups. And not to give a whole history lecture, right? But basically, it was illegal for non-accredited investors to invest in startups. Throughout, say the past 80 years, kind of roughly, putting a timeline on things, until this passed in 2016 and went active with the Jobs Act. It's now legal for people to invest as non-accredited investors. That means you don't have to be, have $1 million net worth. You don't have to be an uber wealthy angel investor. You can now write these smaller checks. So the way you find the companies, to get back to your question, is they have to be listed through online platforms called funding portals, or by broker dealers. So it's basically a crowdfunding intermediary. The reason for that, right, is to try and prevent fraud in the market, because some of these investors might be still kind of learning the ropes. They might not have as much of a financial cushion to be able to absorb a loss. So the SEC and regulators want to help protect investors, and one of their ways of doing that is that all of these Reg CF campaigns have to be listed on these online platforms. So you can go onto any of these platforms and basically look at all the deals that are listed. Kind of in a short way of finding things, you can go there and you can browse it. It's kind of like a lot of them are set up kind of like a social feed. You can sort by industry, you can sort by keyword, you can do which companies are trending or have raised the most or are active this week, that type of thing. But that's one way you can go, is actually going to each individual platform. The other way you can find them that might be also help kind of organize things a little bit more is to go to some of these aggregator platforms that basically, I think there's something like 70 plus funding platforms today where companies are listed. So it's not just like the public markets where if you have a brokerage account, say with Fidelity, for example, right, you could buy a stock on any of these different exchanges. With equity crowdfunding, if you want to invest in company A and company A is on platform B, you have to go to platform B to invest in that. So because of that, it is a little bit hard to find deals, because you basically have to have an account with each one of these platforms and then be looking at all of them. So to help alleviate that, there are some of these different deal aggregator websites that basically will look across all the platforms and basically consolidate that to a location and allow you to kind of filter and sort based on that, to be able to find deals that are interesting to you. And then from that, you jump over to the website and you have to make the investment through that website. Now, in addition to that, right, a lot of these companies can actually do kind of public ads and social media. They can basically say, hey, we're raising capital, check out our page here. So you may come across companies, just from your interests and different things like that. If you browse on a couple of these platforms and then, go on Facebook or you go do a Google search, you might start seeing some ads actually, for some of these companies. So maybe you're not actively looking, but they will come into your feed one way or another.
Especially
Yeah,
since they're on these platforms of their own, and they have their, these different platforms have their risks or benefits or pros and cons. And also the fact that they're now being shown through ads, it's opening up to a lot of people, not just investors, but just, the general public. So to paint that picture, what are the overall risks and benefits?
Ivan, do you want to jump on the previous question of the due diligence first, or do you want to move on to this one?
I thought that this one would be a better transition, and we can go back to the due diligence one.
We can do that.
Got it.
Yeah, so there's you brought up a good point, Ivan, that there are some pros and cons to this. And there was a reason that, for the 80 plus years that the SEC didn't allow private companies to publicly solicit or basically, put ads in a paper, say, hey, we're raising a private, round, come invest in us. And the reason for that, right, is that there would probably be a lot of fraud, and there was in the past. And these are some of the protections that were put in place. So there are very stringent kind of rules and regulations around what these issuers or the companies who are raising capital can and can't say. But some of the pros of this, right, is that if I'm a company and I'm raising capital, maybe I'm not from the San Francisco area, I'm not from New York or Boston or some of these different tech hubs. Maybe I don't have all the connections in my immediate network. Traditionally, it would be really, really hard for me to raise capital early on, right? Because a lot of that is often dependent on what's called kind of the friends and family. And if you don't have investors who are into this, that kind of know the startup scene and have the connections to some of those bigger investors, it can be really hard to get traction. And that's why probably a lot of founders in the past weren't able to raise that capital. Well, now what this basically does is it allows you to leverage your existing crowd, right? So if I have a customer base, or I have a large network, or maybe I'm a social network, right, and I have a bunch of users, I can now actually advertise and communicate with them to invest in us and turn those customers into investors, which has never really been able to happen before. It wasn't really technically legal under most situations under the prior regulations, but that's now possible with equity crowdfunding. In addition to that, never mind that I have some existing customers, but to your point, I can go and say Facebook ads, and I'm going to look for people who are interested in this specific hobby and this specific thing, and actually kind of target people and be able to reach out to completely new people who don't even know me already and say, hey, we're raising capital on this website, think you might find us interesting, think it might be aligned with your interests, check it out. So it's really a great way of being able to democratize the access to capital, especially for a lot of these companies that maybe traditionally don't have some of those connections that some of the startups like in Silicon Valley and that type of thing would have. So what are the cons of that, right? We have to be aware. There's the pros. You're getting out there more. It's being public. Yeah, the con is that with anything with money, right, there's going to be people who try and game the system. So we have to be really careful that there's no fraud, that people aren't just kind of standing up a business and say, hey, I'm raising $1 million, give me $1 million, do a whole bunch of Facebook and Google ads, and then take the money and move to another country. So that's what these regulations try to protect against, and that's what investors need to be aware of, is that when you see some of these companies, as long as they're, again, at least being listed on some of these platforms, that's the most important thing to check first, is that if they're on this platform, there's at least some amount of diligence that's been done, and some bad actor checks, anti-fraud. But then you really do still have to take it another step further as an investor with due diligence and say, okay, so maybe this company isn't outright fraudulent, but is it a good investment opportunity? And that's where due diligence comes in. So I'll talk about due diligence now with that segue. So, due diligence as an investor is traditionally something that, right, you would probably have done in person as a larger angel investor. If you were writing a $50,000 check, you might fly out and sit down, have a one-day meeting with the founder, try to get to know the team, look at their product. Now, as a smaller investor, on some of these crowdfunding platforms, if you're writing $100, $500, $1,000 check, it doesn't make sense financially or from your time perspective to be able to do that, nor is it feasible for the founders of these companies to be able to sit down and talk with every single potential investor one-on-one, because you could have hundreds, if not thousands, of investors. So how do you do due diligence for some of these equity crowdfunding companies that are online? One of the biggest ways, and one of the biggest things that I use, is honestly going to, again, the campaign page on these funding portals and looking at the investor Q&A, because what you will find is that basically all these investors, all these potential investors from all different backgrounds, maybe some of them work in this specific industry or this niche. Maybe some of them have a complete outside perspective looking in. Maybe some of them are business experts, or, have certain digital marketing or other expertise. You get all these questions from all these different perspectives being asked of this company and this founder, and you get to see how they respond. And that has just been so insightful and eye-opening to me, because you get to learn from all these people, where, if you were doing like a normal angel round, you might have a couple angel investors who are kind of doing their own due diligence, but you're not kind of getting all this diverse input and perspective, and you are able to get that. So that's definitely one of the biggest resources, I would say, is make sure you're doing that. But you have to be resourceful, right? So a lot of these companies will also do investor webinars and kind of do like AMAs or Q&A sessions. make sure you attend that. So, they'll be going over a lot of info. All the info that you really should need should be on that campaign page as well, in terms of what's their business model. What are their, if they have projections, what do those look like? What are their financials? And all of the that information also has to be filed with the SEC in what's called their Form C filing. But again, a lot of that is kind of, checking the box. So it's really up to the investor to say, look at it and assess, okay, is this a good investment opportunity? Another thing to realize too is that each of the platforms may take a different approach to the amount of diligence that they do or don't do, which, can be a plus, because maybe that, where in the past, if you had a really small number of people who are kind of controlling which companies got funded or not, as venture capitalists, now it's more up to the decision of the crowd, of kind of the wisdom of the crowd. Is this a good investment opportunity or not? So there are some companies out there, and some platforms rather, where they will do due diligence, where they'll maybe kind of try and do more deal curation, versus other ones that basically will just say, this company is, probably kind of meets the minimum requirements of Reg CF. They're not fraudulent, but we're not saying whether or not it's a good investment opportunity, and they leave that up to the crowd. There's pros and cons to each, right? And depending on your investment style, that's why it's really important to kind of lay out your own investment goals, because you want to know, why are you investing? Are you doing it because you want that high financial return? You're looking for that, unicorn who's going to be a high growth company? Or are you looking just to fund really interesting ideas and, really passionate founders, and, maybe your friends or other people who are raising that, that you're a part of community of? And, depending on your reasons for investing, it's going to drive the types of companies you invest in. So in addition to that, just use every tool at your disposal for due diligence. Go to LinkedIn, right? Look at their past experiences of the team. Try and download the product. Honestly, that's like the simplest thing that probably most people don't do. If it's a software app, right? If it's something you can use, just test it out. Does it kind of jive with what they're saying in terms of what they've done, or are there weird bugs, or is it really, really good? You can kind of learn a lot through that. And in addition to that, there are some investment recommendation and kind of newsletter services out there. Now, obviously, you got to vet each one of these and kind of understand, who's behind it. Are they getting compensated for these reviews and that type of thing? But, that's another way that you can kind of add to your own due diligence, where maybe it doesn't fully replace it, but maybe it complements it, where you can use that to help you make your investment decisions.
Thanks, Brian. So with your due diligence process, do you have a mythology on what you stack rank, and like what's most important for you? Is it team, traction, the product tech, or timing, total addressable market? How do you determine, what's a good investment for you?
Yeah, it's for myself, and it's nothing, novel. It's kind of a pretty standard, whether it's 5 T's or 7 T's, right? Everyone has like kind of a different investment style. I definitely look at the team. I feel, early on, and again, this isn't anything that's, rocket science or anything that's new. Lots of people know or say that the team is one of the most, if not the most important things. The reason for that, though, right, is it just makes intuitive sense. If you look at the failure rate of these companies, right, there's so much that can go wrong early on. You don't know if they might get squashed. It might have new competition come in. It might have regulations, hard regulatory environment, or different things like that could squash them. There's just so many unknowns. So you really need a founder who is driven and passionate and wants to succeed no matter what. Like, that's probably one of the most important things. Another thing in terms of like the founder or the founding team that I really put a lot of emphasis on now as well is their adaptability, right? Because it doesn't necessarily matter, has this specific person done this specific thing in the past? But if you have evidence that they can learn quickly, that, they can execute, that they are interested in, kind of being able to adapt to any environment, that's like, as you guys probably know, like, it's one of the most important things where you're kind of especially when you're starting out, right? Is just how quickly can you adapt and learn and pivot if you need to, and handle with everything that's going to happen, because stuff is going to, come up. They're going to run into challenges, and they're going to have to be able to figure it out. In addition to that, definitely looking at, all the other things, product, obviously, depending on the type of company, if it is, like a software company or that sort of thing, is it a capital efficient or like capital intensive business? And really the valuation obviously is very important. It is kind of, almost more of a art than a science, though, right? It's really hard to figure out valuation, because you might have two companies that otherwise are exactly identical, but one might have twice the valuation just because the founder had a past successful exit, for example, right? So that's one of the things that you'll kind of learn once you start making more investments and really just getting more practical experience, is really I would say be patient, sort of pace yourself, because you will learn a lot of this, and a lot of these things that might be kind of hard to put an exact science or, an exact number on will start to become more intuitive as you see more of these companies over time. But in addition, of course, the market, the TAM is very important. If you're looking for a financial return, right? You want to make sure that they're not just aiming to be, open a couple shops and, in one city, but that they really want to have a global scale or have a massive impact if you want them to be a big potential return. And then traction, right? Again, that sort of, again, depends on their valuation though, because you'll have different thresholds of what traction you might expect depending on where their valuation is at, and kind of everything else related to that. So
great response, Brian. Thanks for that. So what are you noticing right now with some of the most successful equity crowdfunding campaigns that are out there? What are they doing to get attention? I know you mentioned ads earlier, but
yeah, ads are, I don't even want to say they're a necessary evil, because there are companies out there who have been very successful without even doing any ads, honestly, paid advertisement, that is. So there's a couple things that companies have to do though, right? It definitely is not if you build it, they will come. You can't just put up a campaign page and the money starts flowing in. That's not how it works. It's still a lot of effort. So on the effort side, it's kind of the different ways that you can drive qualified investor traffic to that page. So one of them is, of course, leveraging your existing audience. So whether that's friends and family or whether that's customers, can be a huge benefit. So that's where, especially, if you're like a consumer brand or you have a really large following or a large audience to leverage, that can help you get a lot of traction right out of the gate, because you can kind of market to them and kind of have them invest, and maybe even do that before any other big public pushes, so that when you do start your big public push for your crowdfunding campaign, instead of having $0 and zero investors, you already have maybe 50K and a couple hundred investors, or maybe you have 100K. That can be really good for kind of coming out of the gate with strong momentum, because that's seen as a social proof, right? It's kind of a signal for other investors that, oh, hey, like, okay, here's this company, here's this founder that I don't know. I've never met them, but I see there's already a few hundred people who you have committed money. And so that's kind of a positive signal. And that can actually kind of lead to, kind of a flywheel effect, where the more investors, the more momentum you get, the more you actually attract, which attracts more investors, and so you can kind of do really well like that. So that's definitely one of the ways or techniques, is really kind of having just a strategy to have a strong start to your campaign and then be able to maintain that momentum. Now, of course, as we mentioned and have talked about, you can do some paid traffic through, Google ads, Facebook ads, that type of thing. In addition to that, I mentioned, there are these investor networks out there. So if you can get in front of them and get recommendations, that's often, a really good boost to kind of your momentum of your campaign. And in addition to that, just going to your networks, right? So both your existing networks. So again, kind of leveraging, if you have friends or investors or other people, maybe just connections on LinkedIn, right? Like reaching out to people who have similar interests. But then once people have invested, I think something that's underutilized as well is asking those people to either re-up their commitment, right? Because it might be, oh, thanks for investing $100. We're trying to hit the next milestone. Consider upping your investment to 250, and maybe you have another perk level or something like that. So perks are another thing as well that can kind of help drive investment, demand as well, if that's really structured and set up pretty good. And then asking people to share too, right? So these investors are invested in you, and they're going to be aligned long term. Ask them, share this on social, especially. So one, kind of technique to help out is if you kind of pre-write their, the Twitter or the Facebook or the LinkedIn post that you want them to share, and say, hey, we already have all these little snippets, just take this and quickly modify it, share it with your audience. It'll help us, kind of come a long way. Investors are great for that. And that can kind of really help spread your reach pretty quickly. So those are probably kind of some of the best tips I have for, starting out.
Brian, thanks. Those are some really, really good tips. And just remember, like, as to make it as easy as possible for them to get the word out is key. But thank you so much for sharing your experience and wealth of knowledge with the community here. And thanks, Brian.
Thanks for having me, guys. I appreciate it.
Thanks, Brian.
All right. I think that's
that was
good.
Great. Cool. Brian, I'd love to ask this one as Brian, what is your secret actually at looking at all those deals to actually finding an investment? And if you had that outlier of, winning an investment? What was it that you did and you did well when due diligence?
You're not going to like my answer, but I'll tell you my secret, which isn't really a secret, but no one knows which companies are going to succeed. Like there's no way to know. So this is maybe what my secret would be, but you'll kind of see how I'm spinning it. So I would say that it's vital for investors to keep an investment decision log and write down at the time that you invest your objective reasons of why you're investing. Now, the reason that I tell you to do this is kind of twofold. One is that it will be able to help you kind of adapt and improve your process over time. Because you'll be able to see why you invested in companies and then reflect 5 years, 10 years from now how that worked. But what's almost kind of like funny, and what I've seen with my own investments through doing this with investment decision log in this process, is that the companies that I was most excited about and I thought were going to be the most successful so far have not panned out. And some of the ones that I honestly invested for purely the perks. So I have one company that I invested and I wrote down, I'm investing because I want this perk. That is on paper my best investment today. And I never would have guessed, right, that company would have done that. So it kind of just goes to show you that like early on, there's just so many different things that can happen, right? And I think it's really, it's hugely important. And I'm very interested in kind of like the behavioral investing and like human psychology side of investing, because it is such a crucial point. It's like it plays such an important part of it, but I think people don't even know that it's there, right? So what probably happens for the most part is that a lot of people are investing emotionally because something, whether it's the founder, the idea, something they said, the vision, it's resonating with them. And then really when they're going through due diligence, you're really kind of just justifying that emotional decision that you've already made to invest or not. Which kind of sounds crazy, but honestly, I've seen it in my own investment decisions. And so by writing it out, though, you can start recognizing some of these patterns. You can start seeing where you're making good decisions or bad decisions, and you can start reflecting, because there's always an element of luck too, right? So you not only have to know, did you make a good decision or a bad decision, but was it a good outcome or a bad outcome? Because you could make good decisions that have good outcomes, but you can make good decisions that have bad outcomes just because of luck, and vice versa. You can make a bad decision that has a good outcome and think like, oh, I'm a genius. But if you go back and look at your investment decision log, you might realize now, oh, maybe I shouldn't have made that investment. Like I kind of lucked out in how it worked out, but overall, it wasn't the best thing. So I don't know if that really answers your question, Jeff, but I would basically say an investment decision log is essential for any investor who really wants to improve their process and see how they're doing over time. And then that no one really knows what's going to be successful. And, anyone who tells you that they do, even the best will tell you like they can't pick the winners. Like invest in good people, kind of you can kind of weed out the ones that don't have a chance at being a really big outlier, but there's no way to know which ones are going to be the good ones. So
I love it, Brian. Thank you.